Hello, family. I pray that you're doing well. My blog, which is brought to you by Legacy Investing and Wealth Management, is designed to simplify investing, to empower you and give you the most recent stock market analysis. For more information, including my past blogs, please go to legacyinvestingwealth.com. Again, that's legacyinvestingwealth.com. Look for the Market Mondays tab, which you'll find under the Legacy for all of my past blogs. So we're still dealing with stubborn inflation. It's caused by a tight supply of resources and a lot of other factors. It's likely now that this country, like many others, are going into a recession soon, or it's possible that we're already in one. The Federal Reserve continues to increase the interest rates to cool down the inflation. Demand for loans has almost stopped, hurting the housing market and the stock market. Home prices are dropping and the stock market is seeing a prolonged sell-off. The rising rates are also hurting corporate profits, which usually will start layoffs and a rise in unemployment, further slowing demand for products and services. This is what usually triggers a recession, but all the different measures that the economists use will kind of confirm that in the months to come. All three major indices are in bear markets. And again, a bear market is when you're down over 20%. The NASDAQ is down almost 35% for the year, S&P 500 down over 24%, and the Dow is now off over 20%. If we look at the last few bear markets, they tend to last about a year and a half on average. And we're currently in 9 months into this stock market sell-off. So I think that we could have a ways lower to go. Bear markets are usually the best time, and I'm not going to say usually, I'm going to say always the best time to start investing and set yourself up for future success. If you have a lot of money just sitting in a bank account, just consider opening a brokerage account and getting started. I can manage it for you if you have a considerable amount of money, or you can manage it yourself. If you have a 401k or some other type of retirement account, you should definitely stay the course, continue buying and averaging in at lower prices. Even if the economic recession doesn't start until early next year, the stock market always recovers first. So it's likely that we're going to see a great 2023. If we have a deeper recession than anticipated, then we'll recover, but probably at some point later in the year. After recessions, it can take years to get back to new highs, but it always happens. And this is going back since the late 1800s. Here's a look at the technicals of the stock market. The S&P 500 topped out in January of this year at 48.18. And some technicians are looking at the February 2020 high that was right before the pandemic started of 33.93 as a level to look out for. If it doesn't stop there, then look out below. We could go down to 3,000 to around 3,200 or so, which is about another 20% lower from here. So in times like these, you're going to have bear markets where you get suckered into the market when you see the market rallying and it goes up 1,000 points for the day and you're like, oh, everything is good. So you jump in and then only to get surprised and it goes lower and lower. That's what happens in bear markets. So I want you to be aware of that. So give me a call if you have questions about the stock market, about the financial markets. I would love to chat with you. I have a lot of information to share, and my services could possibly help you. So I would love to talk to you about your financial goals and see if I can help you. If not, it's cool. I'm only a phone call away or for any questions or quick advice that you want. So I want you to commit to building your legacy this year. Let's connect and build generational wealth together. Thank you very much for tuning in, and I hope that you enjoy the rest of your day.